Many of you have asked me for an update on Mercado Libre stock, ticker symbol MELI. The stock is down 21.5% over the last months. It was down 10% yesterday on earnings, and it's down another 1.6% today. Now, normally, whenever you have an overreaction on earnings, not all the time, but most of the time, the stock tends to go down, the market overreacted, and then it tends to recover the next day, or sometimes it even recovers in the same day. But this is clearly not the case with MELI. I believe some investors and analysts, they're concerned about something. So I'm going to talk about some of those concerns in today's videos. I'm going to talk about the report, which was amazing, but I'm also going to talk about some risks and some uncertainties that I see in the earnings report. And I really hope you enjoy it as always. Now, the earnings report was actually amazing in my opinion. GMV grew 37%. The revenues grew 45% year on year, or 47% on an FX neutral basis. And that's surprising a lot of people, because many analysts, I've been following MELI for a while, and many analysts believed long ago that the growth was unsustainable. Yet MELI is still growing like it's a microcap. It grows 47% in revenues. And this growth is apparently more sustainable than most of us believe. And that's really, really amazing for the company. The unique active buyers on their marketplace has been growing 24% year on year to 83 million people. And the crown jewel of MELI is Mercado Pago, and it loves the financial kind of fintech space for MELI, which is underserved in Latin America. 78 million people, up 27% year on year. All those things are really, really amazing. Now, the question is, why is MELI going down? Some of it has to do with the margin compression, EBITDA margins, operating margins, net income margins. Most of them have been compressing, but this is EBITDA margin. Used to be 17.5%, then 15.7, 15, 12.5, 10%. This is a massive, massive deceleration in EBITDA margins, and most of their margins have been decelerating in a major way. Now, MELI's management team claimed that they're decelerating due to the company investing for growth. And that's really amazing. You want a company that's really reinvesting for the long term to drive revenue growth, drive earnings growth, and then once they get a dominant position in Brazil and in those areas, then they can start to monetize, their revenues through increasing prices and just monetizing margins in general. But if a company is growing, it's in a growth stage, it should not be focused on maximizing profitability. It should be focused on maximizing growth within a reasonable range. And this is what MELI is doing over here. And this is what they should be doing. But in my opinion, the worst part of MELI, which, the part that I really didn't like, is the credit portfolio. The credit portfolio is huge, over 18.8 billion in asset under management, up 78% year on year. Anything from merchant credit to credit cards, and also consumer-related loans and consumer credit. Now, if we look at their loan portfolio, 16.8% of total loans are 90 days plus past due. Not 1 or 2%, guys. Almost 17% of their entire loans are 90 days plus past due. This is crazy. Now, this number hasn't been increasing, which is great. If it was increasing a lot, I would have been saying that MELI is trying to give credit to more people to grow their revenues, because they give you credit and you buy things from MELI. So it grows the financial services business, and it also grows the marketplace and e-commerce related business. This is clearly not the case here. But 17% of all loans being 90 days plus past due, this is really big, guys. This is really aggressive in terms of qualifying all those buyers. They're really getting aggressive. And if you look at their operating income margin, or I should say EBIT margin, their EBIT margin has decelerated from 13.5% to 10%, down 340 basis points. What was the biggest contributor to this margin compression? Bad debt. Bad debt or bad loans, maybe the people didn't pay or they were past due, they accounted for them as bad debt. They took off 2.5% of EBIT margin from MELI. So this is becoming a problem, in my opinion, with all those loans being past due, and the portfolio is growing in loan size, up 87% year on year. And MELI is, I don't know how lending standards are in Latin America, but they seem to me like they have a little bit of a looser lending standard, where they're lending money to a lot of people. A lot of people are being past due, they're not paying back, and that's starting to weigh on the margins. 2.5% just because of bad debt. That's really big in my opinion, and I think it has the market somewhat concerned. Now, the second reason for the decelerating margins or the margin compression is due to the company reinvesting more in growth, and this is their net income margin. It has decreased from 10.5% to 6.4%, massive deceleration, mostly due to cost of goods sold plus OpEx. Now, if you look at the investors' letter for MELI, most of those investments were related to lower free shipping threshold in Brazil, where I believe the free shipping was like up above $100, it was free. They took it down to $20, and they're doing other things like credit card investments and other kind of investments, which is really helping them grow in general as the company wants to take market share in Brazil and in other geographic locations, and they're reinvesting for the long term. All those things are really amazing, and this is what you should want a company to do. But I believe the way analysts are looking at it is they're looking at it more of a permanent compression, like a permanent investment, like a series of investment, or you could say more like a race to the bottom. Because the reason why MELI is doing this is because they want to take more market share. But the main reason why they're really doing this is because they're facing a lot of competition. So in Brazil, it's not like in the United States, you have Amazon and that's it. Maybe you have a few others, but you really use Amazon. In Brazil, you have, and this is an older chart, but you have Mercado Libre, you have Shopee. Shopee has been taking a lot of market share. You have Amazon, which is expanding there. You have Shein. You have AliExpress, and you have like 3 or 4 different websites. So you meet people. Not everyone uses Amazon or everyone uses Mercado Libre. Maybe they use Shopee. Maybe use Amazon for other things. They use something else. So it's really different. It's much more competitive than what you have here in the United States. And a lot of analysts believe that this is just the start of it. And then once other companies they start to invest a little bit more and do more things, MELI is going to have to lower shipping thresholds again, and it's going to have to do more things because there's just so much competition, and it's more of a race to the bottom in terms of net income margins. I'm not saying this is the case. I don't know what's going to happen over there, but I believe this is what the market is believing, and this is why the stock is selling off, and it has been selling off every quarter where MELI has pretty much decelerated in net income margin. Now, looking at the valuation is down from like 50 times earnings to 29 times earnings. 29 times earnings, guys, is really cheap, you could say, for a company that's growing in earnings per share, 47%, expected to grow 38%, 30% plus for many years to come. And you're paying 29 times earnings for a company that you could say has some kind of a logistics moat or a physical moat in Brazil, as they have the fastest shipping. I talked with a lot of people from there. They told me the fastest one is MELI, but if they want something related to consumer electronics and quality stuff, they buy them from Amazon. If they want something on the cheaper side, they buy it from Shopee, and a little bit on the clothing and other kind of items. So they use different websites for different things, but MELI has a logistics mode. They invested in logistics. Amazon is trying to catch up. Shopee is trying to catch up, but it's going to take them a while. So I believe under one PEG ratio for earnings growth, they are sustainable over the next 5 years. It's just really hard to ignore. So I believe a lot of the bad in MELI is now priced in the stock. I think the stock is undervalued here at $1,700 without a doubt, as you're paying 29 times earnings for a company that's likely going to continue to grow earnings 35, 40% plus for the next 3, 4, 5, 6 years. And if MELI stocks remains flat and they grow 30% a year for the next 5 years, the P/E ratio would be like 12 or 14 times. I mean, there's just no way, in my opinion, or it's unlikely, I should say, for MELI to remain flat over the next 5 years. So that was my opinion on MELI. I just wanted to focus a little bit more on the bearish case or on the other side of the trade that I wanted to talk about. So I really hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.